Hi, everyone. Welcome to this month's Climate Solutions Investing Series call featuring Schroders Capricorn Investment Group and the Cambridge University Endowment Funds. I'm Aisha Lee, IEN's Program Manager for Climate Justice and Events, and I'm really excited for all of you to join us today. Now, before we get into the conversation, there are a couple of details that I'd like to go over, starting off with what this webinar series is about and what IEN focuses on. So as a refresher and for any new faces, IEN is a peer learning network, and we focus on encouraging endowments to invest in sustainable ways, to really open pathways for an equitable, low carbon, and regenerative economy. And we do this through various ways. So resource exchange, education and training, and forums and meetings, such as this one. Now, this Climate Solutions Investing Series is a series that is a part of our Net Zero Endowments initiative, and it's focused on market insights and investment opportunities within climate solutions. So, to run through some housekeeping, first, this webinar is being recorded. We also invite you to use the chat function to comment, any questions that you have throughout the call. We will have some time after the conversation for Q&A, so you can all ask your questions. In the meantime, please remain muted for the duration of the webinar. Now, without further ado, I am excited to hand it off to Kate Rogers, Global Head of Endowments and Foundations at Schroders, to kick off this conversation.
Great. Thank you so much for that. And hello, everybody. So my name's Kate. As Aisha said, I'm Global Head of Endowments and Foundations at Schroders, which means that I work with endowments and foundations around the world to match their needs with investment solutions. We look after about $20 billion worth of endowments and foundations globally. We do find that there are some common characteristics of these types of investors, as you'll be aware, no doubt, hopefully, tend to be very long-term investors, often investing to perpetuity, very much prepared to take risk, therefore, to look through any short-term noise in order to get attractive returns and generate a profit in order to support their spending for their beneficiaries. That tends to mean a real long-term focus on inflation plus spending as the overall asset allocation, as the overall asset mix target. And that means from an asset allocation perspective, tending to favour real assets like equities, private assets, real estate, etc., and perhaps opportunistically into things like credit, etc. The most recent, or the last decade, we've really seen a change in investment practice in terms of aligning with mission and values. So a lot of endowments and foundations seeking to align their investment strategies with what they believe as an organisation. And clearly that links into broader sustainability goals and impact goals, and as the conversation is today, about climate change. And so that's what we're focusing on. We're trying to talk about moving from climate ambition into action in endowment portfolios. And I'm joined by the amazing panel of Joel Beckman from Cambridge University Endowment Fund and William Oram from Capricorn Investment Group. We will be talking about that. So maybe, Joel, do you want to introduce yourself and your organisation first?
Sure, thank you, Kate, and good afternoon or good morning, everyone, depending on where you are. Very happy to be here, and thank you for the invitation. So my name's Joel Beckman. I'm Communications Lead at UCM, University of Cambridge Investment Management, as the investment company for the Cambridge University Endowment Fund. And most of my role involves liaising with our stakeholders. So we have multiple investors, possibly slightly differentiated from other university endowments, a collegiate structure at Cambridge. So we have actually 22 investors in the fund. So I do the investor relations, the stakeholder engagement across the university, especially around topical issues such as the one we're discussing today. And lastly, I'm responsible for a executive education program that we run for our fund management partners, which I'll come on to talk about. Very quickly, the Cambridge University Endowment Fund is a 4.2 billion, which is large in the UK university endowment world. Portfolio, single product, multi-asset, unconstrained global fund. Asset class is very similar to the ones that Kate just mentioned. So look forward to sharing more shortly.
Thanks, Joel. And Bill, do you want to introduce yourself?
Yes, thank you for including me in the discussion. So I'm Bill Oram. I'm a partner of Capricorn Investment Group. We are an investment platform focused on sustainable and impact investment strategies with a principal focus on climate. We started the company about 20 years ago, originally to manage capital on behalf of our first capital partners, Jeff Skoll and the Skoll Foundation. And the format was to manage that capital in an endowment style. So long-term time horizon, equity orientation, a focus on supporting both current capital needs as well as long-term capital needs. But what was reasonably unique about us at the time was that from inception, we were organized to invest both to achieve those financial outcomes, but also integrate sustainability, impact, and specifically climate risk throughout our investment activities. So obviously that's become much more mainstream and common, fortunately, but at the time it was clearly more unique. Today we've expanded and institutionalized our business into really three core areas. So we continue to focus solely on climate and impact investing. We principally work on behalf of mission-driven families and foundations, and we do it in three different areas. So first, we have an OCIO business, which again does the same that we've done for Jeff and the foundation, but for other institutions in which we integrate sustainability and climate throughout diversified multi-asset class portfolios. We also have a GP stakes business in which we provide growth and catalytic capital to emerging impact and climate investment managers, in which we're trying to help build the field and build more firms that are purpose, are oriented towards climate strategies. And then the third area is that we have a clean tech and climate solutions venture capital fund.
Great, thanks, Bill. So a key issue when we're sort of starting out for endowments and foundations in terms of their climate policy journey is really understanding what the motivations of the organisation are when they're thinking about climate in terms of their investment portfolio. So, for example, an investor that prioritizes avoiding conflicting with the mission or is worried about reputational risk of investing in certain sectors might tend more towards exclusionary policies in their investment policy versus an organization that's motivation is to try and enhance the energy transition. They might bias their investment policy towards influencing the companies that they're investing in or investing in climate solutions. So we often start off when we're talking to endowments and foundations by starting off with the motivations of the organizations. Bill, I'd be really interested to hear your perception of what the key motivations are for climate action that you see with US investors that you work with.
Yeah, of course. And look, we see, as you noted, we see the spectrum. I'll caveat all of this by saying that most of the families and foundations that we work with, are mission driven. It's reasonably clear in terms of what the programmatic focus is. So in some ways, our job is a bit easier because they've already decided ex ante, to use some portion of their capital to support the mission. Whereas other stakeholders, other pools of capital have a more diverse set of constituents. But in some ways, we benefit from the clarity of purpose of our capital partners. But with that said, look, we certainly see what you outlined, which is the focus on programmatic alignment. This idea of promoting a clean, resilient, and sustainable global economy is top of mind for many of our partners. And I think a recognition that the scale of an issue like climate is so large that you need all pools of capital, right? You need government, you need philanthropy, but you clearly need to leverage capital markets and the financial system if we are to scale up to the trillions and trillions of dollars per annum that's required. So this idea that if you are a foundation or an endowment with a social or environmental objective, you do need to figure out ways to leverage the corpus in service of that programmatic focus. And so we certainly see that as probably the starting point for many of our asset owner partners. I think the second is also what you illustrated, which is somewhere in between kind of alpha generation and returns and the more programmatic focus, which is this idea of future-proofing portfolios. You know, our view is that climate is uniquely systemic risk and has material economic implications. It's not just on individual assets or individual sleeves of a portfolio, but on the overall global economy and markets. And so therefore, we see a lot of asset owners that gravitate towards the integration of climate risk because they want to think about it at a systemic level, right? i.e., how do I build a more resilient portfolio which mitigates systemic or shock risk? And then the third is really the full illustration, which is this idea of alpha and return generation, right? As I said, there are very few segments of the global economy where you can look out in the next 20, 30, or 50 years and have reasonably good visibility into the scale of capital expenditure that's going to have to occur. And we can debate how quickly that happens or if it happens, but I think at least in our view, it's reasonably visible that there's going to be a large scale kind of, industrial transformation and energy system transformation. And asset management is very well suited to be an enabler and a beneficiary of that. And within that, very large capital expenditure initiative that's going to occur, there's going to be many, many pockets of opportunities. And so if you think about an endowment or a foundation with a perpetual time frame and a very long time frame, it's very well suited to take advantage of what will likely be some inefficiencies, mispricings, and secular opportunities along that pathway. So I didn't answer your question terribly well by kind of narrowing in on any one of those, but certainly in the U.S. we see expressions of each of those type of investment models.
Interesting, thank you. Joel, over to you. I'd be really interested to understand, and I know that the University of Cambridge have been on quite a journey. It would be really helpful to understand the motivation behind the climate action that the Endowment Fund has taken.
Sure, yeah. I think common to lots of university endowments, I think towards the end of the last decade, we saw a lot of the impetus from stakeholders around the university in terms of what the endowment was doing on sustainability. I think that's not just students, it was also academics, faculty, departments, and other constituent pools of capital around Cambridge. And I think the other factor that I would like to mention is Cambridge is obviously a world-leading university and commensurately also leading in climate science. So it felt like there were a lot of things aligning for us. There was also a new team that came in to run the Endowment Fund in 2020. So that enabled us to really focus on the kind of wider aspect about transparency, not just on sustainability and in things like exposure to conventional energy, but across how the Endowment Fund engages with, communicates with, and interacts with stakeholders across the university. So that, I guess that was the kind of a few different things coming together at the same time around 2018 to 2020. And then since then, that's really allowed us to push a lot harder in what we wanted to do. So there's been a more formal sustainable investment strategy that's been put in place, a real emphasis on transparency and engagement with various stakeholders around the university. And I think also just kind of from my seat coming in for the last couple of years, the team that's now running the endowment fund, it would have been something on a kind of personal, moral, societal basis that they would have wanted to do anyway. So that's kind of the drivers really, and then that strategy has been going now for 4 years or so. We feel like we've been able to pull some of those levers pretty well. This may be Kate. Should we come back and talk about the specifics later, or should I delve into those now?
Well, I think maybe if I just outline the different levers of change that hopefully we can all agree on. I think when we're talking to endowments and foundations across the world around what their options are when they have thought about wanting to take climate action within their investments, they've thought about the motivations, what are the sort of levers that they can pull within the investment portfolio. There's really 4. There's avoiding stuff. So, that's your sort of divestment or exclusionary type of policies. And that tends to be, where people are trying to move away from the dirtiest sectors or the dirtiest areas of, of the markets. There's integration, which is obviously a bit like you were saying, Bill, around making sure climate risks and opportunities are integrated into every single investment decision, because as we know, climate change will affect very, very broad every business probably in the world. There's allocating to solutions, so it's what you avoid but what you actually allocate towards. So that's where actually people are taking specific decisions to allocate towards climate. And then there's influence as the 4th, which is how you use your position as a shareholder or position as a investor in funds to try and encourage climate action in those companies or those investment vehicles. So I think those are the sort of 4 levers of change, and what we see from different endowments in different places in the world is each of them using those levers in a slightly different way. So maybe we'll come back to you then, Joel, because you were talking about it. Obviously, we've seen that the university have applied this net zero commitment. Perhaps you could give us a sense of which of those levers apply to the university endowment at the moment.
I think all 4, but to differing degrees. So I can run through some of the commitments. So there was, again, going back to 2020, there was commitment to remove conventional energy exposure from the portfolio. There was some exiting of liquid public equity funds where we were able to do so then. And our commitment is to have no meaningful exposure to conventional energy by 2030. There's just a kind of side note of one kind of illiquid fund that the current team running the endowment inherited, which will take a little while to run off, hence the sort of 2030 timeline, and a longer term commitment to for the endowment fund to be net zero by 2038. So that was quite an ambitious target, but again, that's aligned with the university. So the university has a stretched target to be net zero by 2038, and given that we are effectively a Scope 3 emission of the university, that was our way of trying to align with that and support the university and not be a separate entity, as it were, in terms of our ambitions. We also made a commitment to add and allocate to the transition and to renewable energy. So that the commitment at the time was to be in the range of 3% of the endowment. I am pleased to say that we're just over 3% of commitments, including current invested and future commitments. So we're at over 3%. So that is actually higher than our conventional energy exposure in 2020. So that feels like that we've kind of gone past that tipping point, and I know that's been a kind of equation that lots of endowments have used. But I think the biggest lever of the ones that you mentioned, Kate, is on influence and engagement. So again, there's a relatively small-ish fund, 4.2 billion. If we look at our core managers across the portfolio, there's 56 currently. Common with lots of endowments, those are very long-term partnership style relationships, where some of those relationships are ones that the investment team have had previously in previous roles. Those are some new relationships that have come in through our selection and due diligence process. But those relationships are really important to us, and where we feel where we have influence, especially when we're investing, for example, in relatively small-ish GPs, we feel like those are really good opportunities for us to inform, support, and persuade them how to decarbonize their portfolios. So that those are the levers that we've pushed. Obviously, the first couple I mentioned are a little bit more kind of mechanical. I'm not going to say easy to do, but easier to do. But the longer term ones, in terms of decarbonizing the portfolio, we really see as a proposition for how we engage with those partners over a long period of time. Oh, I think you need to just come off mute, Kate.
Sorry. You've developed this executive education course. Do you want to tell us a bit more about that?
Yeah, so I think, I'm not sure how unique this is, but I think it's relatively unique. But I think one of the things, so we talked earlier about alignment of mission. I think this maybe takes that down another level of detail, and that we've actually aligned not just the mission, but actually the work of the university as a leading global education institute. And that we're very fortunate to have a part of the university called CISL, Cambridge Institute for Sustainability Leadership. And we have worked with them to put together a bespoke executive education program. And that has been a phenomenally successful thing. So that I would bracket under the heading of the support that we're able to provide managers through our engagement strategy. And we've now run 4 cohorts of that program over the last 4 years. We have had 26 GP firms go through that program. So in aggregate, that represents around $250 billion of capital. And one of the things that we are quite insistent on is that it's always the kind of managing partner, CEO, CIO, PM level people that attend that program. So they go back to their organizations and they can push that through on a top-down basis. So they're not just sending their kind of most junior ESG analyst and it sort of ticks a box and it doesn't really go anywhere. And that's been, we've had some incredible impact stories coming out of that, of some of the firms and things that they've done and aligning their net zero objectives with ours. So 2038, bringing CISL, the organization I just mentioned, into their firms to deliver the program for the rest of their organizations. Managers who have incorporated climate and environmental factors into their equity analysis of how they're actually constructing their own portfolios. So these have been real wins. The feedback's been amazing. It's a substantial commitment on the part of the GP. We normally ask for 3 senior people from the firm to come. It's a 3-month program, not a continuous, but from beginning to end 3-month program. It's a series of workshops, webinars. It concludes with a day and a half in-person workshop in Cambridge. And it really goes from kind of the very kind of high level outset of climate change and the risks to their portfolios, and then drills right down into how they can kind of really think about portfolio construction, analysis, value creation, where are the opportunities, and to really think about it in the way that we're thinking about it. It's been hugely beneficial. And I would also say for us, another sort of side factor is that just getting our GPs together in one room or through one program has been hugely valuable in terms of the networks and the connections that have been made. So, for example, in our buyout portfolio, we now have a sort of little cluster of 5 or 6 firms who are coordinating with each other on best practice and what they're implementing in their day-to-day investment strategies, and that's also been really positive to see as well. So I'll leave
Love
that there.
Yeah, it's a sort of systemic change, isn't it? Being able to influence managers at that level. Bill, I would love to hear from you the actions that you're taking in terms of climate action with the clients that you work with.
Yeah, of course. And look, I think it's interesting to compare and contrast to some degree, right? Clearly, we don't have the scale or brand of a Cambridge or Schroders, right? And I think it's always important, for institutions to figure out what's unique to them and play the cards that they have, right? So we obviously have this heritage from Silicon Valley and very much an orientation around entrepreneurship and innovation. And part of the reason we ended up with this very deep focus on climate is not just because we think it's a systemic important issue with critical application and implications for individuals and the world as a whole, but also because it's actually perfectly suited for innovation, capital markets, entrepreneurship in a way that some other areas around impact maybe aren't as much, right? We ultimately view climate as being addressed through capital market solutions and innovation and entrepreneurship and technology. And so part of the reason that we gravitated to it was because we had some initial founding principles that made us very well suited to see if we could be helpful in this area. But they're always, every institution is different. And so when people ask the question of, well, which of these, divest, integrate, allocate, influence, hopefully everyone will ultimately get to doing all of them, but the starting point is usually the one in which there's the least barriers to entry for you, as an organization. So we started in the strangest of places, which we started in the highest risk category, right? Because we had this venture background, and we kind of then worked backwards to the things that today are maybe most, I still don't think easy or not risky, but we didn't start doing infrastructure or bonds, right? We started trying to address the innovation and the catalytic capital problem up front in some of this deep tech, hard tech, where there really was no capital being deployed in the early days when we started the firm. But back to your original question, right? Everything we've done has been some evolution of learning and making mistakes and this or that, right? So we started the company 20 years ago. I think we always had this idea of long-term responsible stewardship in which we are integrating the risks and opportunities of systemic issues like climate, and really tried to internalize some of the externalities in our client portfolios. And again, I think endowments are somewhat unique in that I view one of the biggest headwinds to the integration of climate or sustainability or impact to not be that people don't kind of care about these issues. It's that the time horizon of their capital isn't actually well suited to deal with these issues. So it's more of a time horizon and a alignment issue than it is that folks are just oblivious to the fact that these are very real issues. It's that most people don't think in 10, 20, 30 year time horizons, and endowments, because of their purpose, actually do. And so in some ways, endowments are very well suited to think about these issues, right? Because it's not how much can I earn in one given period, as the goal, right? It's what are the best returns that I can earn over the longest period of time is actually the goal for many endowments, right? The idea of true compounding. So again, I think that's why endowments have such an interesting role to play in all of these areas. Look, as we got more sophisticated and frankly, as the market evolved, so, this is 2005, 6, 7, we became more explicit in our focus on investments that aligned with the UN, Sustainable Development Goals. We had more intentionality around a solutions focus. We started to figure out what we were good at, what maybe we weren't so good at, where we wanted to find partners, where we wanted to internalize that. And for me, it's always about the developing concentric circles of competency, like in any investment program, right? But in this one in particular. And then now where we are today is very much in this idea of allocating towards, solutions. And, on the net zero side, and then I'll kind of stop, we have made a similar commitment to what Joel outlined. And well, I think it's perhaps easy to be critical of some of these frameworks, and they're not perfect. I think what net zero did in many ways was gave a framework that allowed people to think about the entirety of the portfolio, right? It's not just divestment and it's not just solutions. There's a big swath of any portfolio which needs to be decarbonized, right? And in some ways, when you're only dealing with divestment of the easy things and you're only dealing with solutions of the very kind of directly applicable strategies, there's large swaths of the global economy, like the built environment, like the industrial complex, like agriculture, that I don't think have been addressed to the degree that they could be. And they're critical for emissions. They're critical, for sustainable economic development. And I think the net zero does a good job of enabling asset owners to think about how do they decarbonize the entirety of their portfolio, not just rely on those two pillars. So we're very focused on that, right? We've, that overall decarbonization of the entirety of our portfolios is a very significant focus today. And again, I think net zero has been a big part of helping us kind of think through that.
And you're launching a specific climate solutions fund, is that right?
Yes. So we, so we do advisory, working with families and foundations across the entirety of the portfolio, but we're always looking for ways to catalyze more capital going to address climate and have a solutions orientation. So we have a GP stakes business, which is really focused on building the field, as I said. So how do we grow private equity firms, private credit, infrastructure, emerging infrastructure firms that are well suited to absorb capital and in turn scale their own assets and hopefully, ultimately deploy that capital towards solutions. And the theory of change for us is that, again, there are trillions and trillions of dollars that need to be deployed into climate. And if you compare the scale of the capital needs relative to where the asset management industry is today, there remains a large gap. So we have to do a lot to build up the capacity to deploy this capital in a high quality way. So our theory, obviously from an impact standpoint, is that will be highly catalytic. From a financial standpoint, as I said, I think asset management is going to be a critical enabler and also beneficiary of the transition to a sustainable economy. And so we'd like to own the rails, right? We don't need to be perfectly right about the technology, but if you own the rails around how this capital is going to move, it's going to be a very profitable endeavor. So, we are, as I said, we're a reasonably entrepreneurial firm, and we're constantly thinking about ways to leverage our platform to kind of help with this overall transition.